Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Monday, April 20th. The first quarter reporting period has pretty much started as expected. Major financial firms have beaten depressed expectations. Other companies have beaten less depressed expectations, yet few companies are pounding the table about the outlook. By and large, it can be said that the batch of reporters in the past week did not do any harm to the prevailing view that the worst of the economic slowdown and the financial crisis is behind us. Still, neither the earnings reporters nor the economic data created an impression that it is smooth sailing ahead. The 1.1% decline in March retail sales was disarming, given the broad-based nature of the declines in discretionary categories, while the industrial production report was just plain disappointing, declining 1.5% and rounding out a first quarter in which output dropped 20% at an annual rate. Continuing jobless claims rose to a record 6.022 million. The stock market, however, continued on its merry way and logged a gain for the sixth consecutive week. With the latest gain, the S&P 500 is up 30% from its March 6 low. Naturally, with each tick higher, the cries picked up among short sellers that the move can't last. The further the market climbed its wall of worry, though, the more exasperated those short sellers became, and many were forced to cover their positions, which left them in the compromised state of feeding the rally. One of the key elements that stood out for us in the past week, though, is that the gains were harder to come by for the stock market, and that they came on volume that was 13% below the average seen during the rally from March 6 to March 31. This suggests to us that money managers are more reticent than before to chase the rally, preferring instead to wait for pullbacks to stake an ownership claim. Our sense of things is that the market is likely to enter a consolidation period soon as profit-taking starts to increase. Now that the market is just 3.5% below our initial target level of 900, we think it is prudent for investors to pair positions that have enjoyed outsized gains during the rally. This morning, the market opened about 2.4% lower, and that's after several companies, including Bank of America, topped earnings estimates, and Oracle said it will buy Sun Microsystems for $7.4 billion, or $9.50 per share in cash. Bank of America did note that credit quality deteriorated across all business lines, but that's not particularly stunning news given the increase in the allowance for loan losses reported by other banks last week. We think the consolidation phase will be mostly lateral for two reasons. One, investment advisor sentiment data still is not showing extreme bullish readings, and two, we believe there's an institutional bid sitting under the market from managers who missed this rally but are anxious to buy on weakness so that they are in position to capitalize on possible further gains. Where the market goes on the other side of this consolidation phase will hinge on the trends in the economic data in so much as they influence the earnings outlook. For most of the last 6 weeks, the market has embraced the idea that the economy is in a bottoming process. By extension, that would mean there is a belief that the pace of downward revisions to consensus earnings estimates should also be slowing. So participants have not only been buying a potential economic bottom, they have also been buying a potential earnings trough. The potential for improvement has been a powerful driver of the stock market. The scope of the move, though, will now dictate that the data confirm the improvement is for real. It will take some time to flesh that out, but if the next move is to hinge on the data, rest assured the data is going to hinge on the consumer's behavior, which is apt to be erratic still in the face of rising unemployment. In other words, now that the market is beyond the breakwater, don't take for granted that it is smooth sailing ahead. I'm Pat O'Hare for Briefing.com. Thanks for listening.